Okay, so a couple housekeeping things before we kind of dive into material here today. So I know last class there was an issue. I accidentally was using an older version of this daily quiz, and I had someone bring up that it doesn't quite line up with the values that we're using in the other sections. So just to make sure there's clarity on all of it, I've kind of updated that quiz. It's still due until we start class tomorrow. After that due date passes, my mistake is your game. As long as you submit anything on that quiz, I'll end up giving everyone credit for both questions. But I will replace the quiz that has some the questions rewritten, and that could be used to then kind of study for the exam, which is next Thursday. So I also and I have that set of practice problems up. There was two questions which I wanted to provide a little bit more clarity on. So I updated exactly how they were written. I think it was 16 and 18, question 16 and 18. So just making sure if you have the old version, the new version should have some clarifying wording on those two problems. And then that module 3 reading was due before we started today, because we'll start with module 3. So that PowerPoint slides, and then this Excel example that we'll be using in class. And then module 4, we won't start until Monday, so that reading isn't due until we start class on Monday. And the quiz that we have today, it's always 2 class periods after we use it. So instead, it goes over the weekend, so that'll be due before we start class on Monday as well. After that quiz, which is also kind of due at the end of the day on Friday, after that passes, you'll be able to view the correct answers to that quiz. There'll be a quiz next week after we cover the material on Tuesday. It'll be due before the final exam, for the first midterm exam on Thursday. I'll have those answers set to be released as soon as you complete that quiz, and you can kind of use those to study. I'll also get another set of practice problems up for the second quiz. So you'll have the old practice problems, the practice problems from quiz 1, practice problems from quiz 2 to review. And then the Wednesday class next week should primarily be review. So it's a good time to log on and ask any questions that you have over those practice problems, any questions you have over the material that we've covered. And that's kind of our roadmap here through the end of next week. I will also post and go through the first Canvas discussion tomorrow, exactly how to proceed in answering that. That'll be due, by the end of the day next Wednesday, the day prior to that first exam. Now that should, I think, cover everything. There aren't any other questions. We'll dive into the material here today. Okay, so once again, if I do miss something in the chat, feel free to unmute. I'll try to keep an eye on it. No further ado. We'll kind of start thinking about the next topic, which is going to be the gross domestic product, or we'll call it GDP. So we're talking about GDP. What we're trying to measure is the output of our economy. So one thing that'll get brought up several times today is our economy has a circular flow. So anytime somebody purchases something, so anytime someone in a household, or generally we think about ourselves, buys a product, right? That business had to produce that product. So there's going to be an expenditure, but there's also going to be an income that these businesses make when you spend the money. Right? We're also going to see that businesses have to pay households for their labor, or we can think of we'll talk more in depth, they're going to pay interest on loans, they're going to pay for machinery. So they're buying something from households or from other companies. And in return, when you think about the easiest one is labor, we're paying someone a wage, they're going to provide a certain number of hours of work to us. So anytime we have an expenditure, we're always going to have a corresponding output or income. And we'll go through this a little bit more in depth here in a second. So every economic exchange we have, when somebody buys something, there's an expenditure, they're buying it from someone, that other person is going to receive income. Okay. So when we spend money on products, the producers, right, are also going to have to produce that product. They're going to pay workers to produce those products. So we have consumer expenditures, we have producer expenditures. Those will be matched by the fact that employers are receiving these wages that the producers have to pay, and businesses are receiving, right, output from their employees, or they're receiving money spent on the products they're producing. So we've got expenditures, we have income. There's going to be this circular flow to our economy. Okay. And I'll go through these first slides relatively quickly. It's a lot of definition stuff, and we'll kind of spend some more time to work through some actual numerical examples. So what is our gross domestic product, or what is GDP? So it's going to be the total value, or the total market value, of all final goods and services produced within a nation's border and at a specific point in time. So we're measuring GDP for every week, every month, or every year, right? One specific point in time. Excuse me. It also, we can think about this as, well, every unit that's being produced, or a certain quantity, it's going to cost consumers a certain amount of money. Now, it could also be, if we're seeing a quantity of labor provided, there's going to be a price for that labor, which is the wage. So what we would be doing by calculating GDP, you could think about this as, we're taking the quantity of every unit produced times the price of that product, right, what it's going to be sold for, and adding them all up. That's inherently what we're doing at its core. Okay. Now, when we're calculating this at a specific point in time, we're using that current year's prices. If we're using current prices, right, we know that prices can change over time, which last class, we wanted to know how prices change. We were measuring inflation and try to hold constant quantity. However, if GDP is trying to measure quantity or output of an economy, what we want to hold constant are the prices. So if I'm looking at current prices, that would be, we are calculating nominal GDP. We talked about this difference between nominal and real last class. So if we're using current prices, that is going to be calculating nominal GDP. If prices rise, we know that GDP would have to increase even if we produce the same quantity of that good. And so when we're looking at real GDP, which we'll talk about later on, we want to control for prices. Nominal GDP doesn't do that. So when we're using the current year's prices, we're not thinking about inflation. We're not capturing that. So we're looking at nominal values or nominal GDP. Okay. So what is going to be counted in GDP? We know for right now we're calculating nominal GDP. Talk more about real GDP in a second. But what's going to be counted are all final goods and services. Right? So intermediate goods, right? The goods that are purchased to create these final goods. So I think the example I gave last class was semiconductors used to produce electronic products. We would only be including those electronic products in our gross domestic product. Now, we would include those intermediate goods in GDP if they have not yet been used to produce those final goods. So if we have semiconductor production, as long as we have some of those semiconductors that haven't been used to create electronic products, we would include those intermediate goods. Similar idea, we also have raw materials, right? On my block right now, they're replacing sidewalks, and so they're using rebar, right? Which is, they use metal to produce that. If we have metal, right, raw materials that have not yet been used to produce that rebar, the rebar is not getting included in our GDP, but that intermediate raw material of that whatever metal they're using would be. But as soon as that final good is created, we no longer include those intermediate goods that was used to produce it. We're only including that final product. Okay. So what will not be counted in our GDP? Why might GDP, even though it's as best of a measure that we can get for our production of our economy, what's not counted? So intermediate goods that are already used, or raw materials that are already used, we kind of already hit on that, but also used goods, right? So resale of goods, that good has already been produced, it should only be counted once. So anytime a used good is sold, we might think, oh yeah, there's an increase in kind of how much money people are spending. However, that's not generated by the new production of a good. We still have the same quantity. If GDP is a measure of the output or quantity our economy is producing, we still have that same unit, right? It's just changing hands. So we won't include used goods and we won't include transfer payments. So anytime we have a redistribution of wealth, like subsidies from the government, right? Taxes were paid by consumers. They were then given, right, maybe through welfare to other individuals. No new products have been produced. That money is just changing hands. Or you can think about it, that financial product, right? Or the money itself has just been changing hands. So we don't include those. Now, we're also not going to include anything we can't measure. We'll call these non-market activities. So, for example, unpaid household work, or if you're staying at home to watch your children, you're not paying for daycare. However, you are taking your time, right, to watch your children. So if we think about that flip side, when we said, consumers are spending money, they're not spending money on daycare now, but they're spending their time, right? They're not earning an income. That is because they're increasing the quantity of work they do within the household. We're not able to measure that, and so that wouldn't get included in our GDP. Now, the reason why this is a problem is the Bureau of Economic Analysis has estimated this to be, the value of this would be 10 to 15% of our overall GDP, but we're not including that. Now, these are based off of surveys. This isn't going to be the most accurate number, but this is generally kind of what they think it is. We're also not going to measure illegal goods, right? We don't have a way of tracking these transactions, but we know they exist. In fact, their estimate is about 5% of GDP would be illegal goods. So this is things like drugs, things that would be not measured, right? Or are not tracked. So they're not included in GDP, but we know they exist. So GDP will always understate to a degree the production of our economy because it doesn't include these goods. There we go. So I just want to show you another way that we can think about GDP and kind of highlighting that it's only final goods that are being produced in our economy. So it's the total market value of final goods, but won't include intermediate goods. So if I think about, and I think I stole this from the book, but I think I'm hopefully going to do a better job explaining it. Let's say I have a baked good, I don't know, a muffin, right? That I don't know, Soma or some coffee shop is selling. Well, in order to get that muffin, initially, someone had to pay for fertilizer and seed to plant this, maybe it was, I think it'd be what, wheat, right? Well, once they purchase that, they then have to spend money to make sure that this crop is growing correctly, right? And getting it to its final form, which is fully grown wheat, they can then sell to a milling company who then turns that wheat into something that can be used for baking, right? Once we have that product and we bake it, we can then sell it or retail, right? Well, if we were to add up how much money was spent from the sale of fertilizer and seed, how much money was spent to grow it, mill it, bake it, and then finally what it was sold to the consumer as, we'd have a total dollar value of 0.96. Now, the problem is we said we don't include those intermediate goods once we have the final product being sold. So if we were to look at the value of each intermediate good and add them all up to the final good itself, we would think that we should have almost $1 added to our GDP, but it should only be the value of the final product because each one of these prices that were paid kind of gets passed on to the next individual or the next person in that intermediate production process. So if we think about this, the final good is only being sold for 45 cents. That's the total value that should get added to GDP. You can think of the reason why. If we, instead of thinking about the price that had to be, these intermediate products had to be purchased for, we can think about what was the value added of each level of that production process. Well, going from 0 to stage 1, we added 3 cents. Stage 1 to 2, 3 cents, et cetera, et cetera. So if I look at the value added of each step of this production process, when I add up the value added, it gives me that final price that the product was sold for, which that's my final good, taking that good, a quantity of 1 here, times that final price, that would be the value that gets added into GDP. So we don't include intermediate goods, we only include the quantity times the price of that final good, okay? So why do we care about GDP? Right? Well, higher levels of output or higher levels of GDP, we can generally think of are a good thing. Let's think about the flip side. Why would low GDP be a bad thing? Well, if I have low GDP, it's measuring the output of my economy. If output is low, employers don't need as many workers, right? We're seeing fewer goods and services being provided in the market. They don't need as many workers, raw materials, machinery to get that level of, what their current level of output is. So lower levels of GDP, come down here for a second, means that there are fewer employment opportunities, or there's going to be more individuals who want to work, but there aren't jobs for them. It would increase unemployment. Now, we can also think about if there's fewer goods and services out there, right? We would have a lower quality of life for our citizens, right? The more goods that we see, so even if this is, more food that's being produced, well, if I can consume more food, I'm generally happier, right? If I don't have enough food, I'm starving. Like that's a low level of utility. So lower levels of GDP would lower the quality of life of our citizens and also lower their employment opportunities or increase unemployment. So we look at this graph here. I think this was from the Bureau of Economic Analysis. If we looked at each one of these points, is going to be a time period, what the change in the unemployment rate was and what the GDP growth was. So when GDP growth is relatively low, we have low GDP, the unemployment rate should also be higher. So sure enough, when we have low GDP or low growth rates, we see that unemployment increases, right? The change in unemployment is positive, unemployment is going up. As we have real GDP growth rates that are higher, our output is getting larger, companies need more workers, the change in the unemployment rate actually becomes negative. Well, if the unemployment rate, the change is negative, that actually means fewer people are unemployed, more people are going to be employed. So this is, just a couple reasons as to why we want to see higher GDP or higher output from our economy. So going back, we're thinking about calculating GDP. There are different approaches to calculating it. We can use the expenditure approach. We'll start out with that first, which is, well, anytime someone buys something, there is a quantity of the good. Someone is paying the price for that good. That would get added into GDP. It was an expenditure by our households. Anytime a business is paying a worker, or this rent, we think about they're paying for a building or machinery, there's a quantity of workers or machinery they're buying for whatever the price of labor would be wages. The price of these, buildings you would think about as rent. And so there we would take the quantity times the price business are paying, that's an expenditure. So we would kind of add both of those, take those expenditures, add them up to calculate GDP. That's the quantity that people are buying, the quantity you can think about that businesses are buying, multiplied by their price. Now, whenever somebody buys something, there's a business who is selling that output to them, earning income. Anytime a business is paying for workers, those workers, right, are receiving those wages as income, all right, or the factors of production are making money off those businesses' expenses. So that would be the income approach. Because there's this circular nature to our economy, it doesn't matter which of these that we use. They should always match each other, right? We said this earlier, anytime that there's an expenditure, someone is making money or there is income. So those should always go hand in hand. So it doesn't matter if we measure our GDP by expenditures or if we measure it from income, they should give us the exact same values, okay? So this circular nature of our economy becomes important when we're thinking about there's technically going to be two ways that we can calculate GDP. So we'll go through the first approach, which is the expenditure approach. So if I'm using that expenditure approach, sorry, I had to drink a drink of water there. What would be included in GDP? So we're going to have this broken down into essentially 4 categories, kind of 5. So the first is going to be Well, if we're looking at expenditures, the most obvious one is how much are households spending on products, right? So the consumption spending of our citizens, we'll call that C. Investments into capital goods, so these are companies who are spending money, right? They're spending money on buildings, workers, raw materials. These are going to be what we call investments into capital goods. So we want to be careful here. Investments into capital goods, even though it's this term of investments, it's essentially the expenditure by businesses to purchase factors of production. So this is factories, machinery, workers. Coming down here in a second. Oh, I don't have it here. I think I have it on the next slide. What this won't be would be investments that we typically think of like investing in a mutual fund. Why? Well, because investments into a mutual fund is actually consumers spending money on what type of a good? A financial product, right? They're using money as they're spending money. It's an expenditure. It's not on a physical good like food or a computer, but it's on a financial product. So be careful with this investment. It's not going to be investments into financial products here. This is investments made by companies into the factors of production. Now, we're also going to have government spending, right? So this is going to be how much money the government spends on roads, public universities, national defense, all these different public goods. This is going to be an expenditure by the government. So you can kind of think about how does the government get money? It's taxes from individuals, but if I pay taxes, I can't use that money to spend it on products. So it's really going to be, yes, this money is coming from our citizens, but they're not consuming products. They're just giving it to the government, who then purchases these goods. Okay, so C plus I plus G, these are three areas of spending. Spending by consumers, businesses, and the government. Now, the fourth category we have, and I don't think in our top hat they might use NX, but if you look at other resources, this fourth category of net exports is sometimes written, NX. What is net exports? It's the amount of exports our economy has minus the imports. I typically won't use X and M here. I'll kind of write these out, but this would be kind of the shorthand. So why would we add in exports but subtract imports? Well, remember, GDP is looking at the gross domestic product. So if we're trying to measure this by expenditures, when people or when our economy exports something, who is so we can think about it's something we've produced domestically. Yes, someone else is buying it, but it's something our economy produced. When we import something, yes, we're buying it, but we're not buying it from someone who produced it domestically. We're buying it from another country. So that product isn't being produced in our economy or our nation. So instead of adding in imports, we would actually subtract them. This is going to be, not domestic. So even though people are spending money in imports, we subtract them because that money is not remaining within our economy. It's going to a different economy or a different country. So the final form of GDP that we would have is C plus I plus G plus NX or plus net exports, which were exports minus our imports. Okay. So we have this expenditure approach. We can break these goods down into different categories. I'll go through this relatively a little bit quicker so we can get to some numerical examples of calculating GDP. So we're talking about consumption goods or consumers' expenditures. We really have two different categories. So the first is going to be durable goods. So durable goods are any good that someone purchases that has a lifespan over 3 years. This is going to be, things like automobiles, computers, appliances, mutual funds, right? When once again, mutual funds are a financial product, we would still include this under consumer spending. So these goods, once I buy them, appliances, automobile, hopefully they all last more than 3 years. So these would be what we call durable goods. Non-durable goods, it's the flip side, right? It's goods that are going to last less than 3 years. So most food, right, doesn't keep for more than 3 years, so should be a non-durable good. Cigarettes, right? People buy them, and they're consuming them relatively quickly. They're not going to last more than 3 years. And then another one to kind of think about, something like car insurance. When I buy car insurance, that's typically only for a year. So once I purchase it, it's a service, but it's only good for a year. If I want to have more than 3 years, I have to keep purchasing it year after year. So that would technically be a non-durable good. And then services, so these are like actual physical goods. Services will be intangible. They're not something that I can actually hold in my hands, but we still measure them in GDP. There's still an expenditure that consumers have. So think about something like Uber or Lyft. Yes, I'm purchasing a product, but that product, I can't hold it in my hands. As soon as I use it, it's gone. Right? In fact, you almost think about it, it's like a non-durable good that has no lifespan. Right? It's over as soon as I buy it. So these are our three categories of consumption goods. We can then think about what are the categories of investment. So it would include things like investments that companies are making into equipment or machinery or even new technologies, or production facilities, new structures, or adding on to their current facilities, right? Once again, this is not investments by consumers, it's investments made by companies. It'll also include investments they're making to increase their inventory of, say, intermediate goods, right? So they're purchasing raw materials so they can produce their final product, right? Even if that's not today, that inventory increases so they can increase production in the future. It would not include things like personal savings or stocks. We talked about, I've mentioned this several times already. These are consumer products, right? People are purchasing, CDs, purchasing mutual funds, purchasing stocks. Those would not be included in investment. They would be included in consumer expenditures or consumer spending. And then government spending, really, this is just going to simply be federal, state, and local government spending on public goods. And then I already kind of went through this. Why are we adding in exports? Well, because they're produced domestically, even though another country is buying them. So they wouldn't really show up in our consumer expenditures because it's consumers from another country, non-domestic. However, we still want to include them in the output of our economy because they are being produced domestically. On the flip side, yes, imports, consumers are spending money, but that money is making income for other countries. So when we import goods, it's not production within our domestic borders, it's production from someone else. So we don't want to include that in GDP, which is why we subtract it. Okay. Any questions on this before we keep moving? And then, if we add in exports, subtract imports, net exports is technically what we'd be getting added in, or the net benefit from these two things. Another way of thinking about this is when we export something, we're generating revenue. When we import, it's just expenditures that are leaving our economy. So our net exports are kind of like net benefits to our economy. Okay. So you could kind of look at this graph. I put a link up to it. I think it's just kind of interesting to think about these different categories. But notice here, if I've got GDP broken down into consumption, government spending, investments by companies, and then net exports, notice that the largest component year to year, first of all, we've seen all of them increase. So GDP is generally increasing over time, right? This isn't overly surprising. The output, if we're looking at 1950, there's many more types of goods and services, and we're seeing much more of every single good and service sold. Now, what's the largest percent of our GDP? Tends to be consumer expenditures. Right? Another interesting thing to point out, we'll look at the table here in a second that gives us this, but net exports, it's not as obvious here, but notice net exports is actually negative. So our country is exporting less than our imports. And we'll talk about this in a second once we look at some actual data. But I wanted to mention that here, just looking at the graph, we can see net exports are generally negative in the US. So how do we calculate GDP? And so if I gave you this table, it's got different countries and the different categories. How would I calculate the GDP of Canada And how would I calculate the net exports of the US? Well, if I focus first on Canada, what would I do? Well, I would take consumption, add that to investments. So here, this table has investments broken down into investments in the current year, but also investments that are made to increase inventories that I'm holding for future production. So I would add in both of these as investment, add in my government expenditures, and then add in exports, but subtract my imports. So if you want to have this pulled up while we go through this, I would just kind of write this out to kind of show you what this would look like. If we were calculating that GDP in Canada, we took consumption spending, which was, you look at that table, oh, and there we go, 995.1. We would then add in the two categories that we had for investment. We would add in government spending, and then we would add in net exports, which are my exports minus my imports. So notice my net exports here, exports are larger than imports, this value is negative. Okay. Canada is exporting fewer or a lower value than what they're currently importing. So all I would have to do is get this entered into my calculator. I think if I round this to the nearest integer, I get 1,785. Okay. Now just to make a point, we'll go through this more in depth when we look at the expenditure or income approach. But if I ever told you the GDP and I left out one of these categories, whether that was C, I, G, or net exports, if I know three of these and I know GDP, I can always find the fourth, right? One equation, one unknown. Now, if I wanted to calculate net exports, I already did this for Canada. How would I do this for the US? Well, if I look at that table, the US had net exports of, well, their exports were 2,341.9. Their imports, oh, no, 87, 1.9. So their net exports is the difference between the two, which is, I think if I round, approximately negative 530. So I'm just using the values that were in that table to then make my calculations of GDP and net exports. Now, what's something I noticed about every country in this table? Every country has exports that are larger than their imports. How can this be true? Well, if one country has exports that are greater than their imports, that means there's some other country where their imports have to be larger than their exports. It just happens to be that the collection of countries we have here all have negative net exports. Now, this might be kind of counterintuitive, but I'll give the explanation as to why this can occur. And if we were actually measuring GDP in different countries, we'll say maybe why there could be more countries with negative net exports. So if I think about more developed countries, Canada, the United Kingdom, the US, a lot of the goods they export are going to be final products. So a lot of these goods are going to be final products, but the goods that they import might not be as many final products as they are intermediate goods. So remember though, intermediate goods get counted in our GDP calculations as long as they have not yet been used to produce final goods. So these more developed countries, they're likely buying more raw materials, right? Or they're buying more of these intermediate goods that they're then using to create final products. And maybe more of those final products are sold domestically, so they show up in consumption, right? And so even though we're importing them there, those intermediate goods end up being made into final goods, which are then sold in our country. So, here you could break this down and think about, okay, what percent of exports are final goods as opposed to what percent of imports are intermediate goods. But that would be one kind of explanation as to why we see that net export value be negative for a lot of countries. All right. How far do we get today? Just want to make sure we have plenty of time. If we don't, I might come back and revisit something here, but for the sake of time, just to make sure we have enough here today, how would I calculate GDP instead of using that expenditure approach, C plus I plus G plus net exports, if I wanted to use my income approach? Right? Well, my income approach, or calculating national income, a different, just a different name for GDP, would be looking at all the income that is made in every category. So instead of consumption of goods, that would be like the profits that companies are making. Or when consumers buy something, there's, if they buy financial products, there's interest being made. Rent is going to be the opposite of investments into capital. That's how much the capital is receiving from businesses. And then wages, right, are how much individual households are making off providing their labor. And then we have depreciation and indirect business taxes. Kind of hold off on depreciation, but if we think about business taxes, this is really how, if government is spending money, well, where does that come from, right? That comes from the fact that they are taking taxes, or their revenue is from taxing businesses. Okay? So that we're thinking about the income approach, taxes actually get added in, right? This is the amount of money that government is making as opposed to spending. So why would they produce the same values as our expenditure approach? Going all the way back, circular flow of our economy, right? It doesn't, anytime someone spends something, there's an expenditure, somebody else is receiving that money or making income. So it doesn't matter which of these we use, we should have the exact same value. Okay. So just kind of two different sides of the same coin, essentially, to use the kind of old adage. So if I'm looking at that expenditure versus the income approach, those GDP calculations should be the same. So if I kind of take those two equations, this would be what it looks like. Okay. So if I know all but one of those components, I can always find the missing one. I've already mentioned this, but let's work through an example. So let's say I gave you the GDP value. I then gave you the following categories, but I left out wages. So if I use these values, right, we can think about if I'm using the income approach, my GDP is going to be equal to wages plus, make sure I have this in the same order as the slides here, rent, profits, depreciation, indirect business taxes. So I told you GDP was 400. We don't know what wages are. We've got rent being 150, profits are 75, depreciation was 40, business taxes are 55. What must wages be in order for this to be our GDP? It's just a little bit of math, right? So we take 400 is our wages. If I do the math here, I think I get 320. It's just a little bit of algebra now here. To get that, our wages must have been 80. So anytime we're missing one of these components, but we know the remaining, we can solve for that one that we're missing. Okay, so hopefully that's nothing too crazy for a Kelly student, but that's how we would do it. So at this point, we're going to stop for a second. We're going to look at this daily quiz for today. So I made sure I have this one set to be 10 minutes, so we have plenty of time. I think we'll actually be able to go through this pretty quickly. This is just a general check of where we're at. So I'm thinking about the first question here. If I was using the expenditure approach, which of the following would not get added in to our gross domestic product? Well, once again, it's C plus I plus G plus net exports. Net exports are exports minus imports. So which one is not directly included? Well, government spending will be. Investment into capital goods would be. If we had consumption goods, that would be as well. And then exports and imports. Taxes are not going to be included in our GDP because essentially taxes are just a redistribution from households or businesses to the government. And so because we're including government spending, if we also included taxes, we'd be double counting. So we're not going to include taxes. We're only going to be looking at government spending. And then if I had this second question, if I'm using the income approach and I know GDP is 150 million, and I was given the following information about wages, capital, etc., or sorry, investments or rents paid to capital, but I left out depreciation, what must that value be? So this should be, just like the problem we worked through before. I just now know that my GDP is 150. I think I was given wages here are 35, rents paid are 40, interest payments are, did I leave this number? Hold on. Sorry, profits are 25. Sorry, interest payments to rent was 40. What did I leave out here? Yeah, profits are 25. Rents, wages. Sorry, I'm trying to look at this, make sure I write it in the same order. Rents, profits, then got 1, 2, 3. I don't know depreciation. I then got taxes. So this is what 40, 50, 60, 70. What did I leave out? I left out the 20 million in interest payments. So missing one, one equation, one unknown. I think if I do this math, got 130 plus this depreciation category, subtract 130 from both sides, and I get that depreciation must be 20. So once again, just one equation, one unknown. This is how I'm going to kind of solve a problem like that. Any questions on that? So this would be what, 20? So any questions on that one before we keep moving here?
Do we have to type 20 million or is 20 okay?
No, 20 is fine. So everything's in millions here. Since everything is like 10 million, 150 million, we're just thinking about that depreciation must be 20 or 20 million. Everything's in millions here. Okay. Any other questions on this before we keep moving? Okay. All right. So, if we continue to keep moving here, so I'm just keeping an eye on time. We have these two approaches to calculating GDP, but I was probably being a little bit lazy with my speech because when we calculate all of these, we're looking at nominal GDP. I mentioned this a little bit earlier. So if I'm looking at nominal GDP, I'm using the current prices that are spent in each of these categories. So I added up the price of every good times the quantity of that good that's being purchased. So if I do that, whoops, I can think about maybe I had a table that looks like this. So I have just two goods in these economies to kind of keep it simple. So in 2004, I've got the price of cigarettes times the quantity of cigarettes bought. The total value that's being spent on cigarettes is 1,000. I then look at, well, what is the price of coffee? Times the quantity of coffee being purchased. The total value of my economy being spent on coffee is 800. I would then add up those two products, the total value for each of those products. I get my nominal GDP of 1,800. I do the same exact thing for 2025 to calculate the value of each product, add those up to get my nominal GDP. I'm looking at the current quantities and the current prices. Okay. Now, I'll go through some examples to kind of highlight this in a second, but why is nominal GDP misleading? Well, if I have the same quantity, right, but prices go up, well, then my new nominal GDP has to increase. But our GDP should be a measure of output, right? A measure of the quantity of things that our economy is producing. So I've got that Excel file. We're going to go through. I'll show you a little more in depth how I would calculate nominal GDP. We're then going to move to real GDP. So before we go to that Excel file, I guess we'll kind of hit on this. Oops, sorry. How did we go from nominal to real values in the previous module? We had to have a base year. So when we calculate real GDP, we're going to use the current output or the output in the year that we're looking at, but multiply that by the base year prices. So when we're looking at inflation, we wanted to measure how much prices were changing. So we kept the quantity or the number of units in our market basket constant across time. GDP is a measure of output, so we want to keep prices constant. So here, what are our constant prices going to be? Whatever base year that we choose. So what would be true about real GDP in the base year? It's always going to be the exact same as nominal GDP. And then we'll see examples where if prices go up, that means that our nominal GDP will always be larger, but not necessarily our real GDP. We'll kind of see why in a second here. I mean, it will still increase as long as the output increases, but it might not increase by as much. So let's kind of look at this, in Excel form and then think about how does inflation impact this nominal and real GDP. So I'm going to open up that Excel file. I'm going to make sure it's a little bit larger for us. Now I've got a completed version and I have the one we're going to do today. I'm going to add some stuff in and I'll repost this because I think we'll have time to work through some more examples that I think will help. So just to get a little bit, of experience using software to do this as opposed to doing it by hand, how would I calculate the value of each good? I take the price of that good and I multiply it by the quantity. Okay. A little bit of a typo here, it looks like. Forgot my T. I would then do the exact same thing for coffee. I take the price of coffee multiplied by the number of units or cups of coffee being produced in that economy in 2004. Nominal GDP is simply the price of each good times the quantity of goods that's being produced, which we have already done by looking at the values, the total value spent, or the total value of each goods category, or the category of each good. So there's my nominal GDP, right? Now in Excel, I can simply copy these down because it's going to update to the 2005 prices and quantity. And then do the same thing over here for coffee and the same thing over here for nominal GDP. So that's where those values were coming from. We can do this by hand. We could also do it in Excel. Now, what would my real GDP be? Well, real GDP is using the base year's prices, but the current quantity. So here we're going to use the base year of 2024, which means to calculate real GDP in 2024, I'm still using 2024's prices, multiply that by the quantity of that good in 2024, and then do that for the next good as well. So here I can calculate real GDP. What should be true is in the base year, because we're using the base year prices, well, nominal and real GDP would be using the same prices. We end up with the exact same value for nominal and real GDP. Now, when we calculate real GDP, you can think about a thought experiment here in a second. We'll prove it with numbers. But even if quantity stayed the same, if prices are going up, well, my nominal GDP would increase, but really, my real GDP hasn't changed. My economy would still be producing the same number of goods, or the same number of units. So how would I calculate my real GDP in 2025? I take the base year's price, multiply it by the current quantity of that good. I would then add into that the base year price of the other good times the current quantity of that good. So we have seen output increase, but it hasn't increased as much as our nominal GDP would tell us. It's increased a little bit less, right? So anytime we're looking at real GDP, that gap between the nominal and real GDP of the base year is always going to be smaller. And I'll give a little more support of this here later on in today's class. So let's think about a second scenario. So I'll say example 2 here. And we're going to do inflation. Okay. So we'll see why in a second here. So let's say we're comparing 2025. Let's say the values are a little bit different. We're going to have inflation of both goods. So let's say we see that prices have went up. However, if we kept constant the quantities of each good from 2024 to 2025, what's going to happen? Well, I can calculate the nominal value in 2025 and the nominal value in 2025 of these two goods. We could then add the values up. We get our nominal GDP, which looks like it's increased. However, real GDP would be using the base year price multiplied by the current quantity. Add to that the base year price times the current quantity. So if GDP is a measure of output, here our output hasn't changed, right, relative to that base year. The only thing that's changed is the prices, which drove up my nominal GDP, but shouldn't, right? Real GDP is holding prices constant. So if quantities haven't changed, holding prices constant, our output hasn't changed. So if I hit enter here, what should I get? That my real GDP is exactly the same in 2025, even though nominal GDP was higher simply because of inflation. Okay. Any questions on that idea before we keep moving here? Okay. So what if instead I had deflation? Right? So let's think about this. So let's assume, once again, I have the exact same quantities. If I have deflation, so let's say prices go down, when I calculate the market value of each good and then add them up to get my nominal GDP, it looks like GDP is decreased. Okay, so my economy is doing worse, right? Not necessarily. Nominal GDP is misleading. GDP should be capturing just the change in production. My production hasn't changed. My prices decreased, which is what drove nominal GDP down. But if I were to calculate real GDP, it's the base year's price times the current quantity that I'm looking at for both goods. Well, what should be true? If I'm holding constant the price, what has happened to my quantities? They haven't changed. Real GDP, the level of output in my economy, hasn't changed at all from 2024 to 2025. So inflation kind of overstates the change in GDP if I'm just looking at nominal GDP. Deflation would understate, right? Or kind of look like GDP went down when in fact it hasn't changed. I'll save this here. Any questions on this before we keep moving? Okay. All right, so let me think what we're going to do here. So one thing this highlights is that anytime I have price increases, my nominal GDP will be greater than my real GDP. Anytime I have price decreases, that nominal GDP will actually be less than my real GDP, as long as I'm holding constant kind of the quantities there. So with this idea in mind, we'll then kind of move to the next topic, which is if we know we want to use real GDP, I want to adjust for these price changes or hold constant prices so my GDP is just measuring out. So we can calculate a factor called the GDP deflator, right? What this is going to be, and here I want to make sure I had a typo here. It doesn't match up with down here. I was kind of copying and pasting. This times 100 should be over here. So I'm going to make that change. I know everyone had these slides, so I'll update the slide, but I just want to make sure if you had the old ones, we're making that change here. So if I'm thinking about my GDP deflator, what I'm going to do is take my nominal GDP and divide it by my real GDP. I then multiply it by 100, just so we have numbers that are easier to compare. So this is kind of the ratio of my nominal GDP to my real GDP. To get that GDP deflator, I then multiply it by 100. So what would the GDP deflator have to be in my base year? Well, in my base year, if we go back to that Excel example, nominal and real GDP are exactly the same. So what would the GDP deflator be in my base year? This would be 1 times 100. It would have to be 100. Now, what if instead I was given the GDP deflator and I wanted to calculate real GDP? All I'm doing there is rearranging this equation a little bit, moving real GDP over here, dividing by the GDP deflator, and I'd have the following equation. So anytime I have nominal GDP and I know the GDP deflator, I can always calculate my real GDP. So just two different equations. If I knew these two, I could calculate real GDP. If I knew these two, I could calculate my GDP deflator. So a point I want to make here, let me make sure we've got time to do this. I think we've got plenty of time. So yeah. So let's think about this. If I'm looking at my said my GDP deflator is equal to my nominal GDP over my real GDP times 100. So if we had an increase in prices, we said even if we hold output the same, changes in prices would cause an increase in my nominal GDP. Now, if output has stayed the same, so let's think about we have output or quantity hasn't changed, then my real GDP, I've adjusted for prices, shouldn't change at all, which means that if I have price increases, that only impacts nominal GDP, that would cause my GDP deflator to increase. When do prices go up? Whenever we have inflation. On the flip, so this is, typically what's going to happen, right? And we looked at an example of this, I think was the E2 example I put into the Excel file. And we'll calculate the GDP deflator here in a second in that file to kind of prove this is true. If we ever had a decrease in prices, well, once again, we're controlling for price changes. So let's just do the thought experiment. If output doesn't change, real GDP wouldn't change. But if we have a decrease in prices, even with the same level of output, that would decrease my nominal GDP, which would decrease my GDP deflator. So anytime we have deflation, my GDP deflator is actually going to be lower. Anytime we have inflation, we said that GDP deflator was going to be higher. Higher meaning, well, in the base year, nominal and real GDP are the same. So this would be that my GDP deflator is greater than 100. If I have deflation, we know that it's less than 100. Okay. So that might be kind of a, writing out those two scenarios. I try to color code it here. If I have inflation versus deflation, what happens to that GDP deflator? So next thing we'll do is look here, right? Oh, there we go. So how do I calculate these GDP deflators? Well, we have the older time period, or the other example we're looking at with 2024 and 2025. So I can calculate this GDP deflator by taking the current nominal GDP, dividing it by the real GDP, multiplying it by 100. Sure enough, in that base year, I get that GDP deflator of 100. If I do the same thing for 2025, I'd be taking that nominal minus my real GDP, not minus, sorry. I would be taking my nominal divided by my real GDP and then multiplying it by 100. So anytime I have inflation, my prices go up, that GDP deflator should be going up as well. Okay. So I can kind of see that if we go back to my Excel example, how would I calculate these GDP deflators? I multiply by 100, but I take my nominal GDP divided by my real GDP. If it's the base year, I should get a GDP deflator of 100. In this example, prices have went up. So if I'm looking at that difference between nominal and real GDP, the nominal GDP should be higher, which means my GDP deflator should be greater than 100, or that same value we found in the slides. Now here, if output has remained the same, but prices went up 10 to 12 and 5 to 12, we should still get a GDP deflator that is greater than 100. And then if I use an example where I have deflation, well, we said if prices go down, nominal will be less than real GDP, and my new GDP deflator will actually be less than 100. Okay. Any questions on this before we keep moving here? Okay. Just to make a point here, if I were to take, well, hold off on a second. I'll come back to this. I'm going to go through one more thing in the slides before I do that. Okay. So with this idea in mind, if we have inflation, the GDP deflator is going up, deflation is going down. So if I look here, I've got different time periods. I've got my nominal, my real GDP, and that GDP deflator. Okay. So if I'm looking here, what would be my base year? Well, the base year always has to have a GDP deflator of 100. So my base year must be 2012. Right? That's where that GDP deflator is 100. If I had generally, over this time period, let's assume, and if we look at the data, this is true, I always have inflation. So after the base year, if I always have inflation, my new GDP deflator should be greater than 100. Now, if I had inflation, well, if I'm working backwards, that means that prior to the base year, prices were lower. So it's not that I had deflation those years, but the directional way I'm moving is actually back in time, not forward. So every year prior to my base year, if I have inflation, that GDP deflator is actually less than 100. Okay. So what happens? So we know that years prior to the base year would have GDP deflators less than 100. Here's a thought experiment. What if I change my base year to 2016? What would the GDP deflator now be in 2016? Our base year always has a GDP deflator of 100. If I now choose my base year to be 2016, what should be true about my nominal and real GDP? Well, if my GDP deflator, oops, went back way too far. There it is my nominal divided by my real GDP. In the base year, these are going to be the exact same. So if 2016 was my base year, real and nominal GDP would be the same, and my deflator would be 100. Now, which years would have a price or GDP deflator of less than 100 if prices are always increasing? Well, now it would be any time period prior to the base year. So 2015 to 2010. Any questions on that idea before we keep moving? So they're kind of just a thought experiment of what if I change that base year. Kind of use this here in a second. So I want to go through a little bit more in depth as to what's going on with real and nominal GDP. Okay. So let's think about this. Let's assume, right? I'll kind of make a further point here. So we said if we have inflation, then in any year that's not the base year, we had nominal GDP being greater than real GDP every time period past the base year. If my nominal GDP is greater than my real GDP, well, what is nominal GDP? It's kind of the old time period's prices times the current quantity. Nominal I've got on the left side. Nominal GDP is the current prices divided by the current quantity. Real GDP is the old time period's prices times the current quantity. I could think about if I put years to this, this would be like in 2010, right? My nominal GDP is the price and quantity in that year. The real GDP is the price in the previous year times the quantity in my current year. I'm using the base year prices. So if I ever have inflation where prices are increasing, the nominal GDP has to be greater than the real GDP. Let's show why. Well, if I rearrange this equation and I just subtract this from both sides, I've got price times quantity in 2010 minus the price in 2009 times the quantity in 2010 must be greater than 0. That's what's going to be true if nominal GDP is greater than real GDP. If I rearrange this equation a little bit, I can pull that quantity out to the front. I then have the difference between these prices in the two different time periods. So what is the only way that this equation holds? Which, remember, we originally started with the nominal GDP being greater than the real GDP. So the only way this equation is above 0, well, quantities have to be greater than 0, right? We can't negatively, produce negative units. So the only way that this would still be positive is if this is positive, which can only occur if we have prices increasing, right? 2010 prices are greater than 2009, or if we had inflation. Okay. Any questions on this idea before we keep moving? So whenever we have kind of inflation, right, and we're looking at a current year's nominal and real GDP, the nominal GDP has to be greater than the real GDP in that year if prices have increased. Okay. And then if we're going kind of forward in time, let's say, or let's assume that the prices in 2010, right, are less than 2009, or we have deflation, right? Prices are decreasing. What would have to be true? Well, this is no longer greater than 0. This would actually be less than 0, which would kind of flip this sign, meaning that when we have deflation, our nominal GDP would be less than our real GDP. So this is kind of the mathematical support, behind that reasoning. Don't just want to take me at my word, right? You can actually kind of work through the math, and then I say math here, right? Just kind of in general form. So, bit of graph here that we'll kind of look at probably next class. I think I'm going to save growth rates for next class. So let's look back at that Excel example. I just want to kind of point another thing out here, which is, let's assume I didn't give you real GDP, and I only gave you nominal GDP and the GDP deflator. So if I wanted to calculate real GDP, and I didn't have any of this other information, I only had column H and column J, what would I do? Well, if we go back to our equation, real GDP is my nominal GDP divided by my GDP deflator. So I would take my nominal GDP divided by my GDP deflator. Now, what am I also going to do here? I multiply it by 100. So what is this going to be? Well, remember, in the base year, which we had here was 2004, it should be that my GDP deflator is always 100. So these are going to cancel. My real GDP, similar to how we calculated before, should be the exact same as my nominal GDP. Right? Prices aren't going up or down because I'm still looking at just the base year. Now, if I have inflation, right, which we were kind of doing down here, I can use this row, but I could also use the one where we kept quantities the same. What's happening to my real GDP? Okay. Well, I'm still going to take my nominal GDP divided by my price deflator, multiply it by 100, so I can copy this down. Notice, in time periods where output was the same, my real GDP, once again, is the exact same as that base year. We get the same value as if we calculated real GDP using that method where we used old prices and the current quantities. The GDP deflator essentially does that for us. Okay. So in years where I had output increasing, the GDP deflator accounts for the fact that there was also prices increasing. It adjusts that nominal GDP, giving me that lower real GDP. But doesn't matter how I calculate this, it gives me the exact same values. And then, yeah, sorry, we'll kind of leave it. Well, actually, no, I want to make one more point in this before we stop. Remember, this was the example where I had inflation, even though output stayed the same. So notice what has to be true. We said anytime we have inflation, right, our nominal GDP is greater than our real GDP. And we would have a GDP inflator of something above 100. If we had deflation, we said what has to be true. Our nominal GDP is less than our real GDP, and we would have a GDP deflator of less than 100. So the math, right, we went through it, but the numbers, these numerical examples, support the exact same statement. All right, so we kind of have a graph of this thinking about, if I'm looking at the base year, because we typically always have inflation, if we're looking at this, my GDP, nominal GDP is always going to be greater than my real GDP when I have inflation past the base year. And then because we're looking back in time, if we have inflation going backward is actually like looking at lower prices, there our real GDP was greater than our nominal GDP in any time period prior to the base year. So next class, we'll look at growth rates. Now you'll notice I don't have a ton of material left to cover. I'll probably revisit some of the things we talked about today, just go a little bit more in depth. We'll finish kind of talking about growth rates. I likely will start a little bit on module 4. So I'll have, oops, go to the home page here. So I will kind of, oh, there it is. Post these PowerPoint slides and a different Excel example that we'll use. I don't know how much we'll get into module 4 tomorrow. I was planning to start it on Monday. So the module 4 reading is not due before we start tomorrow. If you want to complete it before tomorrow, that might be a good way to kind of prime your brain, but we will kind of cover the majority of it next Monday and Tuesday. So I'll keep that due date the same, even though we might start tomorrow with a little bit, or not start. We will, about halfway through class, maybe start on some module 4 material. Okay. Any questions for me before I kind of end this recording? Okay. And then if you have any other questions,